Ever dreamt of kissing your 9-to-5 job goodbye and achieving financial freedom? Well, sit back and relax because in a moment, we're going to embark on an exciting journey of how just a $10,000 investment in the TSLY ETF, Tech Stocks Long-Term Yield, can lead you to a life of wealth and leisure. Forget about the humdrum of your office job, and let's dive into a world of investing with a carefree spirit. The TSLY ETF is an exchange-traded fund that seeks to generate income and capped gains on the Tesla stock, TSLA, through a synthetic covered call strategy, collateralized by cash and U.S. Treasuries. This means that the fund sells call options on TSLA, which gives the buyers the right to buy TSLA at a specified price, strike price, before a certain date, expiration date. The fund collects premiums from selling these options, which are distributed to the fund's shareholders as dividends. The fund also holds cash and U.S. Treasuries as collateral to cover the potential losses if TSLA rises above the strike price and the options are exercised. One of the main attractions of the TSLY ETF is its high dividend yield, which is currently 48.44%. This means that for every $100 invested in the fund, the investor can expect to receive $48.44 in dividends per year. This is much higher than the average dividend yield of the S&P 500, which is around 1.3%. The high dividend yield of the TSLY ETF is mainly due to its high volatility and price appreciation of TSLA, which allows the fund to sell call options at high premiums. To illustrate how a $10,000 investment in TSLY ETF can surpass your full-time job and make you rich, let's assume that the investor reinvests all the dividends received from the fund into more shares of the fund. Let's also assume that the fund's dividend yield and share price remain consistent over time. Here's an estimate of how much your initial $10,000 investment would grow over different periods. After 1 year, the investment would grow to $14,844 with a total dividend income of $4,844. After 5 years, the investment would grow to $54,975 with a total dividend income of $44,975. After 10 years, the investment would grow to $302,030 with a total dividend income of $292,030. After 20 years, the investment would grow to $9,122,982 with a total dividend income $9,112,982. As you can see, the power of compounding dividends has the potential to transform a relatively low-cost investment into a fortune over the course of a long period of time. Let's put these figures into perspective by contrasting them to the typical yearly salary of a full-time worker in South Carolina, which is somewhere in the neighborhood of $6,000 in the state. According to this calculation, the following is the amount of time that will pass until the investor's dividend income from TSLY ETF is more than his income from his full-time job. After 1 year, the dividend income of the investor would equal 80.7% of his income from doing a full-time job. After 2 years, the dividend income of the investor would equal 191.8% of his income from doing a full-time job. After 3 years, the dividend income of the investor would equal 455.8% of his income from doing a full-time job. After 4 years, the dividend income of the investor would equal 1,083.6% of his income from working a full-time job. In other words, after 4 years of investing in TSLY ETF and reinvesting all dividends, the investor could quit his full-time job and live comfortably off his passive income from the fund. Another option for investing in Tesla is to buy its shares directly. Tesla is one of the most popular and innovative companies in the world, with a loyal fan base and a visionary leader in Elon Musk. Tesla has also been one of the best performing stocks in history, with a staggering return of over 12,000% since its initial public offering in 2010. Granted, the Tesla stocks have not been around for that long, but it has performed invariably great since its launch in 2021. We can definitely say it's so far so good. However, investing in Tesla stocks directly also comes with some drawbacks and risks. One of them is that Tesla does not pay any dividends to its shareholders. This means that investors can only profit from Tesla by selling their shares at a higher price than they bought them. This also means that investors have to pay capital gains taxes on their profits when they sell their shares. Another drawback and risk of investing in Tesla stocks directly is that they are very volatile and unpredictable. Tesla share prices can fluctuate significantly based on news events, earnings reports, product launches, regulatory issues, lawsuits, competition, market sentiment, and Elon Musk's tweets, for example. In September 2020, Tesla's share price dropped by 21% in one day after it was excluded from the S&P 500 index. In January 2021, Tesla's share prices surged by 20% in 2 days after it reported record-breaking deliveries and production numbers for Q4 2020. In February 2021, Tesla's share prices plunged by 13% in one day after it announced that it had bought $1.5 billion worth of Bitcoin. In April 2021, Tesla's share prices soared by 8% in one day after it reported better than expected earnings and revenues for Q1 2021. In May 2021, Tesla's share prices tumbled by 15% in 1 week after Elon Musk tweeted that Tesla would no longer accept Bitcoin as payment for its vehicles due to environmental concerns. These examples show that investing in Tesla stocks directly can be very rewarding, but also very risky and stressful. Investors have to be prepared to endure large swings in their portfolio value and to time the market correctly to buy low and sell high. In contrast, investing in TSLY ETF can offer a more stable and consistent return, as well as a regular income stream from dividends. The fund's synthetic covered call strategy can also reduce the downside risk of investing in Tesla, as the fund can collect premiums from selling call options even if Tesla's share prices decline. However, the fund strategy also limits the upside potential of investing in Tesla, as the fund can lose money if Tesla's share prices rise above the strike price of the call options and the options are exercised. The fund also has to pay fees and expenses to manage its portfolio, which can reduce its net return. Therefore, investing in TSLY ETF can be seen as a more conservative and passive way of investing in Tesla, while investing in Tesla stocks directly can be seen as a more aggressive and active way in investing in Tesla. The choice between the two depends on the investor's risk appetite, time horizon, income needs, tax situation, and personal preference. So, what are the risks associated with investing in TSLY ETF? As with any investments, investing in TSLY ETF involves some risk that investors should be aware of. The fund focuses on individual security, TSLA, which means that its performance is highly dependent on the performance of that security. If TSLA experiences any negative events or underperforms in the market, the fund's value and income may decline significantly. The fund sells call options on TSLA, which exposes it to various risks associated with options trading. These include liquidity risks, counterparty risk, early assessment risk, leverage risk, and volatility risk. These risks may affect the fund's ability to execute its strategy effectively and generate income. The fund holds cash and U.S. Treasuries as collateral for its option positions. These assets are sensitive to changes in interest rates. If interest rates rise, the value of these assets may decrease, which may reduce the fund's net asset value and income. The fund is subject to general market fluctuations and economic conditions. If the market declines or experiences increased volatility, the fund's value and income may decrease as well. The fund operates in a highly regulated industry that is subject to various laws and regulations. These include tax laws, security laws, environmental laws, consumer protection laws, and antitrust laws. If these laws change or are enforced differently, the fund may face legal challenges or increased costs that may adversely affect its operations and returns. Investors should carefully consider these risks before investing in TSLY ETF. They should also read the fund's prospectus and other related documents for more information about the fund's objectives, strategies, fees, expenses, risks, and performance history. Investors should also consult their financial advisors or tax professionals before making any investment decisions. So, there you have it. The tale of how a carefree $10,000 investment in TSLY ETF can lead to financial independence and wealth. It's a journey of patience, consistent contributions, and the magic of compound interest. Remember, this isn't a guarantee, but it's a path worth exploring for those who want to break free from the daily grind and make their money work for them. So, why wait? Start your adventure today, and who knows, you might find yourself sipping cocktails on a beach sooner than you think. Remember to subscribe to our channel if you found this content valuable. We'll see you in the next one.